So recently, Alibaba just announced their Q1 2023 earnings and confirmed that they are breaking up the company into 6 separate businesses. So what does this mean to us as shareholders? Let's find out in this video. So in this video, I'm going to review their latest earnings report and at the same time talk about their plan to break up the company and to list the separate entities. So a lot of people have been asking me, why are they doing that? Why are they breaking the company up? And is that good or bad for shareholders? Well, I think that it's actually pretty good for shareholders because by breaking up the businesses into separate parts and listing them into separate entities, it unlocks the value of the business because currently the entire conglomerate is being priced much lower than the actual value of the individual business parts. So let me give you an analogy. So a couple of years back, I went to Burger King and I saw this value meal where they were offering 5 items for just $4. You've got your burger, you've got your French fries, you've got your cookie, you've got your chicken nuggets, and you've got your drink Coca-Cola. Right? So all this for $4. Now, if you were to buy these items separately a la carte, would you have to pay a higher price? Yes. I mean, the burger alone, now this was a couple of years ago, so before inflation, a burger alone would cost at least $3. So essentially, when you buy this value meal, basically you're just paying for the burger and you're getting the rest for free. And that's exactly what's happening to Alibaba shares right now. So how Alibaba is priced is like you're just buying a small part of the business, which is the e-commerce business, and you're getting the rest for free. You're getting the cloud for free, the logistics for free, the digital entertainment for free, because the way the market is valuing Alibaba, they are assigning zero value to all these other businesses, which is ridiculous because many of these other companies are making serious revenue. Some of them are making pretty good profits as well, right? So back to the analogy. So if you were to buy them separately, I mean, this would be, easily $3. How much would the French fries be? French fries at least $2, right? This cookie, I'll give you $1, and then the drink, $2, chicken nuggets, another $2, and media entertainment, maybe $1.50, right? But you get the point. So what Alibaba's management is doing is they realize that, okay, the market is only pricing our entire value meal at $4, but we know it's worth more than $4. Okay, so we're going to break it up, and we're just going to sell the French fries separately. We're going to sell the drink separately, sell the burger separately, and it's going to be worth a lot more. So for us as shareholders, what happens after this split? What happens after they split and they list all these companies? You will get shares of these new companies paid to you as a stock dividend. So currently I own as well, right? We own shares of Alibaba, which is basically the whole value meal right now. But what's going to happen is that, for example, they are going to spin off and list the cloud business as a separate business. They're going to spin this off in the next 12 months. So once they spin this off, this will become a separate stock with a different ticker symbol. So once they do that, we as the shareholders will get shares in this new company. They're also going to spin off the Cainiao logistics business in the next 12 months. So this will be another stock. So right now, from owning one stock called Alibaba, we will then own Alibaba stock, we will own Ali Cloud stock, we will own China logistics stock, we will own Fresh Hippo stock. So the end game is that from now owning stock in one company, we will own stock in up to 6 different companies. Now there's a catch. The catch is that these 5 companies, they are probably going to be listed on the Hong Kong Stock Exchange, not the US exchange. So in order for you to receive the shares of these new companies as a stock dividend, your broker needs to be able to hold Hong Kong shares. And that's why, for example, I am using Interactive Broker so I can have all these additional shares eventually. But if you don't use a broker that can hold Hong Kong shares, like TD Ameritrade, then you probably won't get the new shares, but they may pay you cash instead, which is okay, you get cash. But after that, when this additional stock rises in price, if you believe in a stock, you won't participate in that future upside. You just get paid off upfront, and that's it. You no longer own the French fries. You don't own the cookie because your broker can't hold it. So the suggestion I have is that if you want to own these new companies, you have to have a broker that can accept Hong Kong listed shares, for example, Interactive Brokers. So now that you understand the concept of the split, let's take a closer look at the business itself. So Alibaba as a conglomerate, again, they've got 6 different businesses, which you're going to split, or rather they're splitting right now. The first would be their China commerce business. So this is all the e-commerce business on mainland China. So you've got all these separate brands like Taobao, Tianmao, or called Tmall in English. You got 1688, which is their wholesale. You've got Taobao Deals. You got Tao Cai Cai. So these are all the China commerce. And currently, this makes up the majority of their revenue and the majority of their profits. So this is like the burger of the value meal. Now, in terms of growth, China growth has been flat. In fact, it's been minus 1% in the last year because of all the COVID restrictions, and China is still in the process of rebounding. But once it rebounds, I foresee the next couple of years, this growth would re-accelerate. But again, for the last 12 months, the growth has been slightly negative 1%. Now, their international commerce, that is the one that has still been growing pretty well, even though there's been this global pandemic. So international commerce is where Alibaba provides e-commerce services outside of China. So you've got all these different brands. You've got AliExpress, you have Lazada, which focuses on Southeast Asia as a region. You've got Trendyol, which focuses on Turkey. You've got the rest that focuses on South Asia, like Pakistan, Bangladesh. Now, the international commerce has been growing at about roughly, if I'm not wrong, about 13% over the last 12 months, which is not bad considering the fact that, pandemic and global slowdown, it's still growing at double digits. Next, their local consumer services business. This has also been growing pretty well, given that China has got shut down and going through this cyclical slowdown. So local consumer services have been growing at 12%. So one of the biggest brands within this business is their Elimi, which is a food delivery business, and it's the second largest food delivery business in China, second to Meituan. And this has also been growing pretty well. Next is their logistics business. This is their highest growth business. Last 12 months growing at 21%. So this is really a very high growth business. And that's why they're thinking, or they're not thinking, they are going to list this business in the next 12 months. So this logistics business is one of the biggest in China, and they're able to deliver to anywhere in China within 24 hours and anywhere in the world within 72 hours. So it's kind of like their China's version of FedEx or UPS. It's called Cainiao. Okay. Now then you've got their cloud business. Now cloud, in the long run, I think there's a lot of growth potential, but for the last 12 months, they went through a big slowdown in their cloud business because of a lot of government regulations and restrictions and stuff like that. So the cloud business only grew at 4% year on year, all right? But I think there's a lot of huge growth potential in the cloud business. Now, these two businesses are very, very small, so it's pretty insignificant, and they're not really growing that well anyway. So I would more or less ignore this part of the business. So again, it's these 5 main businesses. Now, currently, the only business that's really making money is their China commerce business, because that's a very mature part of the business. And the cloud business only started making money recently because it's relatively new. The other parts of the business, although they are growing pretty well, like international commerce and consumer services, they are not yet profitable because they're still not at the maturity stage of profitability. They're still in the high growth stage, if you will, right? So again, a quick look at the last 12 months, you can see, again, their China commerce business is the one that's pulling in the majority of the profits, 184 billion renminbi. And then followed by cloud, which is also just turned profitable, okay? And the rest are, again, not yet profitable. International commerce, you can see, grew at 13% revenue growth, but still loss-making. Local consumer services, grew 12%, still making losses. Cainiao, again, high growth, 21%, still not yet profitable. And digital media entertainment and innovation, that's a very small part of the business that I wouldn't even consider that. So 4 days ago, Alibaba released their earnings results for the quarter and for the last 12 months. So what did I think about the results? Well, there was good stuff and bad stuff. Overall, Uncle Adam thinks it was not bad. It was pretty good. So let's run through the details. Now, I'm interested to look at the year ended on March 31st. So we're looking at the last 12 months of results. Now, overall revenue of the whole business, you can see grew only 2% revenue growth. Now, again, that's not too exciting, right? You want it to grow at double digits and stuff like that, which I believe it will re-accelerate in time. But given the fact that China is just starting to rebound from the lockdowns and all these tech regulations, the fact that it still grew is not that bad. Okay, so overall revenue grew at 2%. That's not the exciting part. But what I found really good was that their margins, their profit margins expanded a lot because of cost efficiency. So you can see that their income from operations, profit from operations grew 44% year on year. So that's great. Company is 44% more profitable than it was 12 months ago. If you look at the diluted earnings per share, so in terms of earnings per share diluted after taking into account the options and stuff like that, grew at 21%, which is pretty good. Diluted earnings per ADS. ADS refers to their US BABA shares. This share refers to the Hong Kong 9988 shares, which is the same in terms of the growth. Both grew at 21% year on year. So overall profit growth was great. Revenue growth was still pretty flat. Now, if we look at the breakdown of their revenue growth, you can see over here, we have got all these different businesses. So their China commerce business is the one that has been negative, right? China commerce minus 1% year on year. And this makes up 67% of the revenue of the whole business. So like I said, I believe that this would re-accelerate once China fully reopens and everything fully rebounds. It's currently in that early stage of doing so. Now, international commerce, that has been growing at 13% year on year and makes up 8% of their revenue. Local consumer services, which is like their food delivery, LME, that grew at 12% year on year, makes up 6% of the business. Cainiao logistics, that grew at 21% year on year, makes up 6% of the business. Their cloud, now this was a bit disappointing as well because their cloud business, cloud is supposed to be a high growth industry because of digitization and all that. But again, in the last 12 months, cloud only grew at 4%, which was not really exciting. But do I believe that this would re-accelerate in the next couple of years? Yes, I believe that this could re-accelerate to high single digits or even double digits once they fully split and they are able to really run it independently. All right. And currently, cloud makes up 9% of their business. Digital media entertainment, only 4% of the business. So it's pretty insignificant, which I mentioned early on as well. So what's their net profit after tax for the last 12 months? So again, from income from operations, you have to deduct all the other non-operating expenses and add the non-operating income like interest and taxation and all that stuff. So the net result, net income attributable to ordinary shareholders, that's the final line you have to look at, for the year ended March 31st, ended up at 72 billion RMB, right? 72 billion RMB. So that is versus 61 billion the year before. So it's 17% growth in net profit after tax, which is not bad, right? Now, the other thing which is pretty good as well is their free cash flow. So again, as you guys know, when we analyze the business, the most important thing at the end of the day is free cash flow. When a company generates free cash flow, it can use it to pay dividends, it can retain the cash flow as retained earnings, increase their cash position, it can use it to buy back shares. So their free cash flow ended 2023 at 171 billion RMB, above 98 billion the year before. So that's a 73% increase year on year on free cash flow growth, which is pretty impressive. So they have also been buying back shares. When a company buys back shares, what happens is that there's less and less shares outstanding. So that automatically increases your stake in the business. So Baba repurchased 21.5 million Baba shares, which are the American depository shares, which is equivalent to buying back 172.4 million ordinary shares listed on the Hong Kong Exchange 9988. So they bought it for approximately $1.9 billion under their share repurchase program in Q4 last year. And they still have an additional 19.4 billion remaining under the current authorization, which means they can buy back another 19 billion worth of shares effective through March 2025. So they are doing all they can, the management is doing all they can to return capital to shareholders, to maximize shareholder value. And you may say, but why isn't the share price going up? Why does it keep going down? Because again, in the short term, the market is not driven by logic or rationale. In the short term, the market is a beauty contest. It's driven by emotions, speculation, geopolitical tension. So that's why you have got this big undervaluation of the actual value of the business. Yes, it can be frustrating holding the stock in the short term, wondering, if the business is doing well, why is the share price going on to keep going down, right? It can be very frustrating. That's why the most important thing as an investor, not a trader, as an investor, is extreme patience. You got to be really, really patient, right? But again, always remember that you got to own a company, a stock, in the context of an overall portfolio. Some people ask me, am I frustrated with Alibaba? Well, not really, because again, it's just one of many stocks in my portfolio. Today Alibaba only takes up about 1.6% allocation in my portfolio. Now, it used to be a bit higher. It went down to 1.6%. Now, why? I didn't sell a single share. The reason the allocation is down to 1.6% is because the market value went down, and the other shares which I own Microsoft, I own Nvidia, I own Apple, I own all the other shares, they went up in value. So automatically, the share allocation goes down to only 1.6%. Am I thinking of adding more shares of Alibaba? No, I'm not. I'm not adding more shares because I still think that even though it is a good business, now it's not as great as it was, because before the tech regulations, it had a very impenetrable moat. But since the tech regulations, their moat is still wide, but not as strong as before. And there's still a lot of uncertainty to its other businesses that are not yet profitable. So when I hold or invest in a business that has got a lot more uncertainty, if you will, I tend to keep a small allocation. I won't allocate, too much to it, all right? Because remember that ultimately, when this is properly valued, it could go up double or triple in price, which means my 1.6% allocation automatically could go up to 3-4% of my portfolio, which in the context of my portfolio, a 4% allocation is already pretty big, all right? Because I've got quite a number of great companies in my portfolio. So always remember, it's all about diversification. So, when people say, I put everything in on Palantir, everything in on Alibaba, everything in on Tesla, I think you're freaking insane. I wouldn't do that, right? Because remember that, again, no matter how great a business is, shit can happen. That sometimes you can't predict. That it's not within your control. So, it's always smart to diversify, all right? Okay, so let me talk a bit about the companies that are going to be spun off in the next 12 months. So Alibaba has already confirmed they're going to spin off and list Cainiao, Fresh Hippo, and the cloud business. So let's take a very quick look at these businesses. So Cainiao is again their logistics business. It's kind of like the China's version of UPS or FedEx, if you will. So they do all this logistics delivery, not just for Alibaba customers, but of course, third-party companies as well can use their services, right? So how successful is the business? Pretty successful. It can now deliver any package to any place in China in 24 hours and any place in the world in 72 hours. And they are aggressively expanding to take on international delivery services like UPS and FedEx and stuff like that. So currently, they are valuing this logistics business at $20 billion, all right? The current valuation. It could go up, right? But currently it's being valued at $20 billion. So when they eventually list this, okay, you will get shares of this new business. Now, how much would the shares be worth? So we can do a very rough calculation based on this $20 billion valuation right now. So if you take $20 billion, all right, and you divide it by the number of Baba shares, Baba is the one listed in the US, that is roughly equivalent to $7.72 US cents per share, all right, based on $20 billion valuation. If you're holding the 9988 share, that's equivalent to 7.59 Hong Kong dollars. Now, if you want, you can go online and read a lot more about Cainiao, about their business prospects and stuff like that. So I think that there is a lot of prospect for the business to grow and for the value to double, right, from there. But again, if it lists at this valuation, you will get this amount value per share of this new company, right? So again, like I said, if you don't have a broker that can hold Hong Kong shares, then you probably won't get the share. You just get cash of this amount, right? This is just my guess at this valuation. So that's Cainiao. Okay, next is Fresh Hippo. Fresh Hippo is another business they own, which is supermarkets, right? Retail supermarket business all over China. It's kind of like Kroger in the US. Okay, so it's their grocery arm, and they're gearing up also for a Hong Kong IPO. Now, again, currently, they are valuing it at $10 billion US dollars, right? Again, it could increase, but right now worth 10 billion. Okay, by the way, you can read a bit about what it does. Fresh Hippo, besides being a grocery chain, they offer a Sam's Club-like supermarket. You know, in the US, they've got Sam's Club by Walmart, right? They offer a Sam's Club-like supermarket experience that includes a dine-in restaurant and 30-minute home delivery. Its grocery brand, Hema Xian Sheng, turned profitable in 2022, all right? Started in 2016, it's headquartered in Shanghai. It has got more than 270 self-operated stores across China as of March 31st, 2022, all right? And based on a $10 billion valuation, that means, again, as a shareholder of Alibaba, you'll be getting roughly shares of this new company that's worth currently $3.86 per Baba share and $3.80 per 9988 share. Again, this could possibly increase in value over time. And finally, Alibaba is going to spin out their cloud intelligence unit, which is their Ali Cloud business. How big is Ali Cloud? Well, in the world right now, Ali Cloud is ranked number 4 in the world. Number one is AWS by Amazon, Azure by Microsoft, ranked number 3, Google Cloud, ranked number 4 is Alibaba Cloud, 4% global market share. So I think in the long run, the growth can accelerate to double digits. But again, the last year it sucked at only 4%. So I think the huge growth in this part of the business. Now, what's the valuation? Again, it's pretty hard to value it right now because, again, it's only just turned profitable, all right? And the growth has not fully materialized. But I would say roughly the valuation would be between $40 to $80 billion, from very pessimistic to more base case scenario. So if you take a median valuation of 60 billion, take a median valuation, that would equate to $23 per Baba share and 22.80 Hong Kong per 9988 share. So again, in 12 months, you will get shares of this new Ali Cloud stock. So again, what's the end game? End game is your one Alibaba share, you end up with 5 or 6 shares of 5 different companies. And theoretically, if you add them all together, they should be worth a lot more than that one Alibaba share. Again, the French fries, the drink, the McNuggets, by a la carte, we price higher than the overall value meal. That's the whole idea of this spin-off, right? Okay, so let me end off by doing a very quick valuation of Alibaba based on its latest earnings report. And this is using a free cash flow model. So first, let me value the Baba shares, and then I'll value the 9988 shares. So the Baba shares are the ones that are listed on the US exchange, which are the American depository shares. So free cash flow for the last 12 months, 171 billion renminbi. Okay, my bad, renminbi. Okay, total debt 156 billion. Cash and short-term investments 519 billion. So one thing I feel safe about owning this company is that it can never go bust because it's got a net cash position. It's got so much cash that it could easily pay off all its debt and be debt free. So these are the kind of companies that it can't go bust, right? It's only a question of, how much does it grow? That's all, Okay, now how about the growth rate? What growth can we expect? So this is something that is highly uncertain. Now, if you take a look at Capital IQ, this is a professional site that's run by S&P Global, right? You can see their long-term growth projection for Alibaba. The mean is 12.25%. 12.25%. That's the mean growth rate. So if we put in that 12.25? Let me just double check again. Yeah, 12.25% over here as the long-term next 5-year growth rate, and then we halve that. We assume that drops by half in the next 5 years, and then tape off at 6%, which is basically the Chinese GDP growth rate over the long run. Number of shares have decreased since the last valuation to 2.5 billion shares. That gives us an intrinsic value of $200 of the Baba shares. So as of, I think yesterday, it closed at about $83, if I'm not wrong. So it's still about 58% undervalued. So could the shares easily double in value once the market price catches up with the valuation? Yeah, very, very possible, right? Now again, this is using the Capital IQ growth projection. What if we use a more pessimistic projection? If you go to Finviz, for example, this is on Finviz. You can see Finviz, they project the next 5 years growth at 6.87%, which is a lot more pessimistic, okay? So I always believe that you need to have a base case and a pessimistic scenario. So if you put the pessimistic valuation in there, all right, that would give you a valuation of $166, which is still not bad because at 83 bucks right now, that's it's still 49% undervalued, right? Even at this very conservative projection. Okay. Now, bear in mind, this is for the Baba shares in the US. Now, for the Hong Kong shares, everything is the same except the number of shares are different because 8 Hong Kong shares equals 1 Baba share, right? So if you look at the the 9988 shares, number of shares would be 20 billion, 988 shares. So for the 9988 Hong Kong shares, the base case valuation is $206 Hong Kong, okay, about 59% undervalued. And for the conservative one, which is this one, it's at 170 Hong Kong dollars. All right, so that's the latest analysis of Alibaba. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.